right. Welcome, everyone. Today is May 20th. We are very pleased to be joined by Bleakley's Peter Boockvar. I am Tim Pierotti. I am joined, as always, by Drew Dokken. And one of the things I think people love about your work, Peter, is obviously you're a macro guy. You're a top-down guy. But a lot of the work that you do is very much bottoms up. Nobody pulls out the data of the conference calls, the really good nuggets that almost always come from the Q&A better than you do. So just to get started, let's talk a little bit about Q1 reporting season. We're basically done. Now we've got some retail earnings still to go. But what has stood out to you in some of the commentary, some of the motifs? What's been interesting about Q1 earnings?
Well, let me start by saying thanks for having me. Also, we own a lot of stocks, and I do stock picking as well. So I need to dig at the micro level to see what's going on the ground. And I do think from an investing standpoint, it's always good to merge sort of the macro with the micro. There's one thing to see, a government reported number, but there's another thing to actually hear from what a CEO is saying in terms of their business. So that's why I try to do sort of both. I think in the quarter that ended in March and the calls we've been listening to over the past month, there's certainly a lot of cloudiness, in terms of one's business visibility. January and February seemed to have started off well, depending obviously on what business you're in, but generally speaking, March, there seemed to have been, a pause button pressed, particularly on the consumer side. We heard that from airlines. We've heard that from restaurants and other consumer touching businesses, even, consumer products companies. One of the calls that stand out to me was Colgate-Palmolive. They sell toothpaste and they sell soap. And when the CEO is telling you that instead of someone going to the drugstore or Costco, wherever, well, Costco you're buying in bulk, but let's just say you're going to Target or Walmart to buy some toothpaste. People aren't buying, 3, 4, 5 tubes on that trip. Maybe they're buying 1 or 2 tubes of toothpaste. And if, you're trying to save a couple of bucks and you're sort of destocking your medicine cabinet, I think that says a lot about sort of the cautiousness of the consumer. Now, it's mostly felt on the lower to middle income consumer, but that's been a trend we've seen for not just this quarter, but for the past year. There's been evidence of clear evidence of a bifurcated consumer where lower to middle income spenders are behaving much differently and prioritizing their spend, being much more value conscious relative to the upper income spender. In terms of anybody touching global trade and goods, obviously, everything is sort of revolving around the tariffs and pull forwards of behavior. We heard from some of the auto companies and auto dealerships about people rushing to get a car before, the tariffs rise, whether that's a new car. We've seen a big lift in used car sales as people try to lock that in. So there's been a lot of distortive behavior that we heard about and a lot of, I hate the word uncertainty just because life is always uncertain. But, if I had $1 for every time a CEO used the word uncertainty, So I think that's really just been the general theme here, when it comes to, sort of the global macro, heard from at the micro level.
Yeah. Yeah. It's been an interesting Q1 in that, earnings have beaten. It's a bit of a game, right? You set the earnings for the analysts, so you beat the hurdle yourself. But obviously we have had negative revisions. Were you surprised there wasn't more of a reaction to the Walmart commentary about that they are going to have to pass through so many of their consumables, so many of their discretionary items as well? Because the market seems to be trading as if, maybe the tariffs will have a little bit of an impact, but probably not much. At least that's my sense of how the market is looking at the tariff risk right now.
Well, no question with the trip back to almost 6,000 in the S&P, which is pretty much give or take where we were before the tariff war started. Obviously we got to 61 and change. That's the market telling everyone that, never mind, we're just back to where we were. And yeah, I agree. It's not like that at all. It's a much different world. And it's not just a much different world because of the tariffs, because the market started to get shaky legs even before the tariffs. And a lot of that had to do with, I think, a rethink of the Mag 7 trade. And the DeepSeek news, I think, certainly was a big catalyst for that. So even with this rebound, the Mag 7 index, which you can actually buy an ETF on it, is well off its highs and still down, I think 5 to 6%, or maybe closer to 7 on the year. So there was a change in sort of tone before the tariffs came about. And at the same time as Mag 7 was selling off, we saw a rollover in the US dollar, and we saw continued, when I say continued because it really started last year, but some really good performance in international markets. So I do think that the world has changed. I think there's a rethink of the allocations to U.S. assets. I think foreigners got way too ahead of themselves in terms of those allocations, whether it was in stocks, corporate bonds, treasuries, CLOs, leveraged loans, or whatever. And they're sort of readjusting that allocation, which is not just a one-quarter thing. It could be a multi-year thing. As I mentioned, the Mag 7 stocks getting shaky legs. And then, of course, you throw in the tariffs. And even if we have a baseline tariff of 10%, if you just do the math, that's an extraordinary tax on U.S. importers. Now, to some extent, they'll be able to offset it. Maybe some of the exporters to us will eat some of that. Unfortunately, with the weaker dollar, that's not going to be a mitigant. So you put 10% on $3.3 trillion of U.S. goods or goods imports from overseas to the U.S., that's a $330 billion tax bill that U.S. companies are having to pay. And just for perspective, U.S. corporate tax receipts are expected to be about $525 billion this year. So you add the two and you're talking almost $900 billion of taxes. Well, I've done the math, very back of the envelope, very basic, nothing sophisticated, that if you use a 21% tax rate to get the $525 billion. Now, obviously, some people pay less, some people pay more, and this is just a general sort of context. That implies $2.5 trillion of pre-tax income. Well, if you now have almost $900 billion of taxes being paid on the $2.5 trillion, that implies about a 34% corporate income tax rate. Well, the corporate income tax rate was 35 before Trump cut it to 21. So even 10% baseline, well, many businesses will be able to handle it in terms of procuring product and still not having empty shelves and the economy being able to absorb it. That's still a rather notable effective tax rate that we're going to have to deal with. And just as the corporate tax rate, U.S. companies do their best to pass it on to the rest of us, they'll try to pass that on too. And getting to the point about Walmart, Walmart has a 3% net income profit margin. So they don't have the space to absorb a very notable rise in their costs. Now, I do think it's telling that you're talking about out of all businesses in the world that has leverage over their vendors, it's Walmart. And that if Walmart can only push their vendors to some extent, because they don't want them to go out of business, they want, a healthy vendor base, then that tells you a lot about the flow through of tariffs. Now, Home Depot then reported, and they said they'll be able to handle it more, but Home Depot sources about more than 50% of their products domestically, and their exposure to China is less than 10% because they've spent the last few years diversifying their base. In addition, they have a 10% net income profit margin. So they have a lot more room to absorb the tariffs than Walmart does. But, a lot of retail, has profit margins that are closer to the 3 rather than Home Depot at the 10. So there's definitely going to be flow through, and there is going to be companies left and right that are sort of going to test it. They're going to test the market. They're going to see what can be eaten and what they have to eat. But regardless, it has to be eaten by somebody. If Walmart ends up eating more of the tariff, that means they have less profits. If they have less profits, they have less capital to allocate to hiring and to building out warehouse space and capital spending. And maybe those products that aren't tariffed that they were originally going to cut prices on, well, maybe now they're not going to cut prices on. So they're not raising prices on those, but they're not going to cut them like they maybe were planning to as we entered the year. And there's less money for stock buybacks, dividends. So it's, the administration's making the argument, well, back in 2018, there wasn't inflation, so the tariffs worked out just fine. Well, the tariff still had to be eaten. And by the way, 2018, that tariff war sent U.S. manufacturing into recession, and the Fed was cutting rates in 2019. So, we don't have to go back that far in time to see what the impacts has been from using tariffs, as a cudgel here.
Yeah, I mean, look, in 2018, we went from an effective import goods tax rate of 2% to 3%. Now we're going from somewhere in the neighborhood of 3% to 12 or 13%. It is an extraordinary number, as Jamie Dimon said today. I just want to ask you one more point on that before I go to Drew. But it's the regressiveness that I feel like nobody talks about. This, whether it's 150 billion and it's half or it's 200 billion, it is a tax increase, especially on the consumer who has the propensity to spend 100% of their income. And I think that is a piece of the tariffs that is underappreciated, that just how impactful it is when you give a tax, when you give a pay cut in a sense to that working class consumer.
Yes, no question. And it's even broader than that, because about 40% of the goods that are imported into the United States are intermediate term goods. So yeah, that is eaten by the company making that finished product. And to your point, whatever they pass on to the rest of us is regressive in nature.
Yeah.
Peter, we just had a Moody's downgrade, and that was kind of the last holdout, right? I mean, S&P lowered their rates in 2011, Fitch was 2023. So does this just further highlight that fiscal profligacy has gotten away from us, or is this something that could be more substantial, like a return to bond vigilantes, a situation similar to Prime Minister Liz Truss experienced in the UK? What are your thoughts on that?
Well, I do remember the 2011 downgrade, and that was sort of a wake-up call. That, of course, was not heeded because we see where debts and deficits have gone ever since. And back then, though, in terms of the market reaction, it was a one-day reaction. That Friday in August of 2011, the 10-year yield rose about 15 basis points. That Monday, the 10-year yield fell 24 basis points because it all was happening around the end of QE2. And people were more worried about the negative economic implications of the end of QE2 and the possibility of a double-dip recession that drove buyers of treasuries, notwithstanding the downgrade. So fast forward to now, the question really is did debts and deficits finally matter? And is Moody's sort of the nail in the coffin in terms of our respectability financially in the eyes of the rest of the world? And, I don't necessarily look at this just as an event. I think it's been a process. If you look at right now, foreign holdings of U.S. assets, and I highlight foreigners because, the U.S. investor that's buying treasuries, the U.S., the retiree, the baby boomer, or the pension fund and the insurance company, they can really care less about what Moody's did with our credit rating, because they're going to buy these treasuries anyway. It's really sort of the eyes of foreigners. I think it also matters for where the dollar goes because a lot of foreign money has been invested in the U.S. unhedged. So, you look at what happened to the Taiwanese dollar a few weeks ago when it fell like 8% in 2 days. And you basically wiped out a lot of insurance company money, which I think totaled into the hundreds of billions into the U.S. market. You wiped out multiple years of interest income in just 2 days of a decline in the U.S. dollar relative to the Taiwanese dollar. So I do think also the market has told you they care about debts and deficits now. Trying to quantify it is difficult, but getting to my point, foreigners hold about 30% of U.S. marketable treasuries. 10 years ago, or actually more like 15 years ago, that was 50%. 2010, 2011, when the S&P downgraded U.S. credit rating, they own about half the U.S. Treasury market. So since that S&P downgrade, in over a 14-year time frame, they continue to buy U.S. Treasuries, but they keep buying less. And that's why that ownership stake has fallen dramatically here. So yeah, they've responded to us, but there are other influences, but I do think debts and deficits matter. I think the market has told us that. In terms of the Liz Truss moment, it's funny because I think Liz Truss got a bad blame then. I think it more had to do with the leverage that was in this liability-driven investment scheme that these pension funds had, and they just got caught flat-footed, and that leverage trade unwound, and Liz Truss was just more of a scapegoat. I think what the proposals that she initiated actually were smart. I think this time around, the so-called Truss moment would be more of our profligacy that is much more dangerous than what Liz Truss went through back then. Either way, your point is that it's sort of it would be a market spasm that would cause either the Fed to step in or Congress to sort of take this situation seriously. I mean, just when you thought we were potentially going to have at least a cut in Medicaid. When I say cut, not really a cut, more of a slowdown in spending and more focused on Medicaid was created to provide health insurance for low income people, but it's become, much more of a broader sort of welfare program where, an able-bodied 25-year-old that can get a job is somehow getting Medicaid as a sort of a welfare payment. Work requirements are, to me, a common sense way of dealing with that spending. And then you had Trump came out and said today, well, just sort of leave it alone. Now, I think they'll have some spending cuts related to that, but, not what should be. So I don't think, if you can't deal with a 7% budget deficit relative to GDP right now with Trump in office and holding both sides of Congress, then I don't know when you ever can. I think while I understand the desire to generate faster economic growth as a way to shrink your budget deficit relative to GDP, we have a spending problem, not a tax revenue problem. And I think that's the major challenge here, that even after this tax bill gets done, and I know we'll talk about it later, I still think that the debt and deficit trajectory is still up, and that we're going to see 5% in the U.S. 10-year before we see 4%.
Yeah. Yeah. And look, it's not a coincidence that Moody's downgraded when they did. We are in this reconciliation process. Everybody remembers Scott Besant's 3-3-3 plan, which was 3% growth while cutting 3% real growth while cutting deficits from 7% or 6.5% down to 3% of GDP. We're not going to do anything like that. And yet we are still going to cut some spending. Now, I understand your point on Medicaid. The idea is to take it back to kind of pre-COVID levels when there was this massive expansion. We can debate all day about kind of the work requirements and how they've gone in Arkansas, where you've really kicked a lot of people off the doles, having nothing to do with whether or not they were working or not. But the point of, I think Moody's doing the downgrade now is that this reconciliation bill, it's becoming very, very clear that there is nowhere near the offsets relative to the tax cuts, that we are going to come out of this with, as Moody said the other day, on a trajectory to have 9% of GDP deficits as we get to 2034.
Yes. I mean, it's very complicated with the influence of the CBO in terms of scoring this and everything, because, the big chunk of extending the tax bill is just extending existing tax rates.
Right.
But the way that it gets scored is, well, over the next 10-year window, there's got to be $4.5 trillion of offsets. And if there's not, then you get this, this debt and deficit number, even though it's just an extension of current reality. So, the scoring gets quirky here. I do want to emphasize again that, the median tax revenue, as a percent of GDP in this country going back 50 or post World War II is about 17.5%. Right. And that's pretty much where we stand. And, historically spending has been about 20%, and now it's like 24%. So, it's the tax revenue thing is not the issue. In 2017, when the corporate income tax rate was 35%, the U.S. government took in about $300 billion of corporate tax receipts. Today, the corporate tax rate is 21%, and the CBO estimates that the U.S. government's going to take in about $525 billion, as I said earlier, corporate income taxes. So by cutting the rate didn't mean you cut the corporate income tax revenue into the U.S. government. So this is a spending problem. We know why. We know where all the spending is going. We know with the autopilot spending that's going on. We know the desire to raise defense spending. We know the $1 trillion bill on interest expense. We know where it's coming from. It's not a surprise. If you take non-discretionary spending, you add in defense, you add in interest expense, that's 85% of the $7 trillion that the government's spending. So it's not a mystery here why we have rising deficits. It's just getting a handle on those entitlements that is extraordinarily difficult. I mean, we had a lot of optimism that Elon Musk was going to cut a lot of money out of the budget on not a one-time fix, but on a sustainable basis. And, it came, and I laud him for what he's done, not necessarily the process of which he did it, but, the goal of what he's done, $160 billion.
Right.
So, that tells you where where most of the spending is going. And it's not just on, the government agency side, and we need to trim a couple of heads here and there and so on. It's, it's a problem because we promised a lot of things to a lot of people in this country that we're afraid to break those promises to.
Yeah. Yeah. Let me ask you about, you said earlier that you see the 10-year going to 5 before it goes to 4. One of the things that we talk a lot about we didn't make this up. You've seen it. BlackRock has written a lot about it. Liz Ann Saunders has written a lot about it. Henry McVeigh at KKR. The big secular drivers that kind of bring the end of the great moderation, aging demographics in the United States and globally. And by the way, as we talk about this, and I want to talk about JGBs later, but you have aging demographics in the developed world. You have protectionism growing all over the world. It's not just the United States that has found a populist appeal to tariffs. And then you do have the whole world, at least the whole developed world, where you have fiat currencies printing money. And how much do you think those big long-term drivers will be part of this re-rating of duration sort of globally?
Well, I'll take that individually. I think there's an argument from some that an aging population, because they look at Japan as being deflationary, but I can argue for a period of time it could be inflationary, because you can get you have people dropping out of the labor force, the boomers. And if it's not, fully replaced by, call it Gen Zers, that you can have a shrinking labor pool, and that can lead to wage increases. Now, I don't believe that necessarily wage increases lead to inflation. Less labor leads to higher wages, and whether that's passed on or not, we'll have to see. But you have the potential of wage costs being elevated for an extended period of time, and retiring baby boomers like to spend money. And if you don't have the supply meeting that demand and that spend, well, that's inflationary too. Boomers, they know they can't die with it. Yeah, they want to pass on a lot of it to their kids, but they're keeping the economy afloat. They're cruising like there's no tomorrow. They're enjoying 4% interest income on T-bills. So I can argue that is somewhat inflationary. Now, this is going to extend out over a cycle, in terms of these big picture things that you talked about. But I think to the point is that maybe we're not just naturally going back to 1 to 2% inflation. That was sort of the salad years in the decade before 2022, and that 40-year decline in the rate of inflation and that 40-year decline in interest rates. I think that is over. I think 3 to 4% after this trip down into the 2s that we're seeing, but on an extended 3 to 5 year basis, I think the TIPS market's underpricing where inflation is going to end up. Because I think that there's got to be some structural things here that's going to lead to, more stickier inflation. When we talk about inflation, at least on the government statistics side, you can't talk about it without talking about rents. Since rents make up about a third of CPI, makes up about 40% of core CPI, rental disinflation is happening, and it hasn't been fully captured within the CPI figure, but it will as we continue throughout the year. but we are sowing the seeds for a reacceleration in rents in the back half of maybe this year, more likely first half of next year into the back half of 26, because we are putting a freeze on the construction of new multifamily apartments because numbers don't pencil out with the slowdown in rent growth and higher interest rates. So that's one thing that higher interest rates are doing, at least on the commercial real estate side, is it's slowing the rate of new supply, which will eventually lead to resumption higher in rents. You asked the question earlier about what I'm hearing on earnings conference calls, and we own stock in Camden Property Trust. So that's always a quarterly call that I listen to. They're heavily in the Sun Belt, so they've been mostly negatively impacted by the flood of multifamily supply. But they talked about in terms of visibility, they think next year with the sharp decline in multifamily starts that you're going to see resumption of increases in rents. And if you're a coastal REIT like Equity Residential, they're seeing stickier rental gains in their markets, particularly on the renewal side. And, the lack of new supply, will also help their markets as we get into 2026. So that gets to my point of, this coming year, we'll have inflation in the 2s. And while maybe it's not staying at 2% as the Fed wants, 2.5% to 2.75% is still pretty close. And if the rental deceleration kicks in, maybe we get to 2. I just don't think we stay there. I think we're in a world of inflation volatility and, again, not going back to where we were pre-2022 anytime soon.
Great. And yeah, by the way, we had a great REIT analyst, Rob Simone, on this podcast, and he agrees with you entirely that as you are, you now really have shrunk, especially the multifamily construction, so much that you may be starting to get to the bottom on new rents. And as you also pointed out, renewals have stayed pretty strong. You mentioned EQR, the non-Sun Belt areas where renewals have stayed very strong. Now, OER is the other part to that. People who own homes and kind of make a guess as to what it would cost to rent their home and so forth. Are you bullish on long-term price appreciation of housing? Just as there's an argument that ultimately shelter and OER are really going to follow what happens to long-term home price appreciation.
Yeah, I know people have an issue with OER since it's not really a factual input, but there is a line item in CPI called rent of primary residence, which is an actual rental calculation. Now that should be that whole number, but rent of primary residence and OER are pretty close to matching each other. So,
yeah.
I don't have the same problem with OER that others do, even though I would have preferred, the hard input of rent of primary residence. That's another thing with, home prices are up, single family home prices are up 50%, 50 over the last 5 years.
Yeah.
And you have, near almost, 7% mortgage rates. So the absorption in multifamily is still going to be pretty strong because, we have an unfortunate situation where that first time home buyer, that Gen Zer, is waiting longer and longer and longer to be able to afford a new home. And they're going to be continuing to rent and rent and rent.
Yeah.
So, that is an issue. And then on the pricing side for single family, because we also have a supply issue where, monetary policy by the Fed over the past 20 years has led us to this point where, the housing market's completely frozen. I shouldn't say completely, that's too strong of a word. Is very frozen in terms of the pace of transactions being at 30-year lows. And, that's astonishing to think that the U.S. population is much greater today than it was 30 years ago. But, housing turnover is no different in nominal terms. It's a scary statistic. The question then is, okay, well, how do we cure that? And some people think, mortgage rates have to go down and that'll fix that problem. But, on one hand, mortgage rates fall, that'll create more demand for housing and the home price will go up. So that monthly payment may not change with a decline in home prices if home prices go up. What we need is more supply. What we need is baby boomers to downsize. We need, the 10,000 baby boomers every day turning 65. We need them to move into maybe a townhouse or a 55 and older community or a condo, whatever. We need them to downsize from their, 4 to 5 bedroom homes, when it's just the two of them.
Yeah. Yeah. Well, I'm not quite a baby boomer, but, I've lived in my house for 20 years. I've got a mortgage in 2 7/8, and I'm the story told a million times over. I'm an empty nester now, and I'm not leaving. right? I can't live anywhere cheaper than where I live in my 2 big house in my high tax community, but still with a mortgage at 2 7/8, I've got kind of the golden handcuffs on, and you hear that over and over and over where we travel. Yeah. So look, we've talked about kind of U.S. inflation and some of those drivers where you have really been outstanding. And I read all of your work. As I say with a mutual friend of ours, when we get the succinct summation on Fridays, we feel like the work week is about done, that we can kind of kick off. We don't know when it's coming. If it's 2 o'clock, we got to work till then. If it's 10 a.m., maybe we kick out a little bit early. But where you've really been excellent is talking about global bond yields. And the anchor of global bond yields, so to speak, has been Japanese government bonds. And as you pointed out in a note today, the 40-year JGB traded to 359. That's an extraordinary number, right? And you have been really out front on talking about this risk and the impact that JGBs will have to the global bond market. So could you talk a little bit about that, how you kind of made that call and kind of what you see going forward and the implications globally to bonds when you have 40-year JGBs at that kind of number?
All right. So a couple of things. The reason why the JGB market I thought was so important to watch for the last couple of years is the Bank of Japan really is the architect of modern day monetary policy, sort of modern day pre-2022, where they experimented and continued on with zero rates and QE and this massive expansion of their balance sheet and, believing that rates at zero was going to somehow be the salvation for, their post bubble implosion from 1989. And it was really Bernanke who copied what the BOJ did. So then, fast forward and the BOJ followed the ECB and the Swiss National Bank and the Riksbank and going negative. They own half the JGB market. Their balance sheet was north of 100% of GDP. And, I think that the amount of money that they spent to flatten their yield curve, I think that there was sort of a global effect to that. Then you throw in zero and negative interest rates elsewhere. And, globally, there was an attempt to flatten yield curves around the world. So when things started to change in 2022 with the spike in inflation and central banks started to raise interest rates around the world, the BOJ was very late in doing so. But the reason why I always paid attention to the 40-year part of the Japanese yield curve, which is the furthest out on their curve, and they started issuing 40-year bonds back in 2008, was that because it was furthest out on the yield curve, it was sort of least manipulated by what the BOJ did on the short end with the overnight rate. So in terms of searching the JGB market for market messaging, the 40-year was always the most helpful. And we've seen over the last couple of years, a notable steepening of that yield curve. And, we talked earlier about my belief that the 10-year yield would go to 5% again. Well, when it did go to 5% in 2023, the kickoff to the move from about 360 in June, July 2023 to 5% by, September, October, was the BOJ essentially getting rid of yield curve control. So what the BOJ did at home had global ripple effects. And I don't think you can analyze where you think the U.S. 10-year is going to go just based on your expectations of growth and inflation and not understand that we had a global bond bull market and now we have a global bond bear market. And that global bond bull market peaked in euphoria when we had $18 trillion of negative yielding securities. That was the peak. That was I argue that it was the greatest financial bubble in the history of bubbles. In terms of dollars, when you turned $18 trillion of assets into liabilities with the negative yield that they had. So I think it's very important that we watch, and to your point about what happens in Japan has ripple effects. If you lose that sort of yield suppressant in Japan, that has ripple effects elsewhere. And also from a flow perspective, the Japanese, because there was a lack of yield alternatives at home, They sprayed money all over the world. The Japanese are one of the biggest holders of U.S. CLOs, collateralized loan obligations, because the Japanese pension fund and institutional investor was searching for yield opportunities elsewhere, where now if they can get that yield opportunity at home, well, that's a lot of potential flows that aren't going to come into the U.S. Japanese are also the largest holder of U.S. treasuries on the foreign side, owning about $1.1 trillion of U.S. treasuries. So what happens there has global repercussions to pay attention to.
Right. Yeah, those flows. Do you think that there could be, we have a little bit of a weak dollar policy, right? We claim not to have a weak dollar policy, but we talk a lot about everybody else suppressing their currency. Well, it's a relative game. If other currencies are going to move up, the dollar has got to move down. When you think about flows, and you talked about it a little bit of the Japanese investors, pension funds, and so forth, having to go overseas, having to go to the U.S. For rate. Is there a real risk here? Do you see a capital flight type risk when you consider the possibility that we're kind of flirting with a weak dollar policy?
Well, I'll expand this. The Mag 7 we talked about earlier, the Mag 7 stocks became a global reserve asset for investors around the world. It wasn't just beloved and owned by U.S. institutional and retail investors. It was an asset class owned by everyone in the world. And the 13 F&Ds came out on Friday, and I went through a bunch of them over the weekend. And the government, the Japanese government, pension investment fund, a big holder of Mag 7 stocks. Well, as of March 31st, and obviously we don't have the April data, which I'm sure you had further liquidations post April 2nd. As of March 31st, they were significant sellers of a bunch of Mag 7 stocks. And you can draw a chart of the Mag 7 index, overlaying that against the DXY, the US dollar index, and they have pretty much followed each other over the past 12 months, both up and down, and most recently down. So you have selling, I believe, of foreign selling of U.S. stocks, particularly Mag 7 stocks. Obviously the market's had a nice rebound here, but those Mag 7 stocks have lagged in terms of year-to-date performance, the global, the broader S&P. But I do think, and this is not just going to happen in one quarter, this is a multi-year rethink of the extent at which foreigners own U.S. assets. And, in a way, we're basically telling them to do that. The tariff war, we're essentially telling people, foreign investors, well, your money is not as welcome here, because we don't need you, right? Canada, we don't need to buy this stuff from you because we can just make it here. And we said that to Mexico. We've said that to a lot of countries. So we're inadvertently telling the world that we don't need you as much as we did. Well, they're saying, okay, well, I get it. Well, we don't need to invest in your markets to the extent that we did. So there's a whole world of other opportunities. 75% of global GDP takes place outside the U.S. 96% of the world's population lives outside the U.S. So I think we should not take for granted our standing in the world, and that we should still treat our customers well. And no matter how successful your restaurant is, treating your customers well is probably a key to that. And if you want to continue with that success, you should continue to treat your customers well.
Yeah, very well said. You're not going to be 70% of global market cap forever if you are not welcoming foreign direct investment.
You're talking about a huge amount of dollars just going from 70 to 60, 60 to 50. And even 50 is well above the size of the U.S. economy, as I just mentioned, relative to global GDP, and also U.S. profits as a percent of total profits. The U.S. markets have been punching well above its weight for a while. So all you need is just some mean reversion. So just some pendulum swinging in the other direction. And you're talking about a lot less dollars that are invested in U.S. markets. And that matters for a market that's trading at 23 times earnings again. Right. Going from 23 to call it 17, I'm just throwing that number out there, that's a big difference in where the S&P goes if just there is a multiple rethink because there's less flows into the U.S.
Yeah. Yeah, no, it's a very important point that I don't think people understand. It's not this idea that everybody's going to turn around and sell their U.S. assets, but if they simply reinvest at a lower overweight, at a lower crazy overweight, then that has repercussions. We talked a little bit about some of the multifamily REIT names. Of course, this is not investment advice. This is for educational purposes. But what sectors do you see a bull market, or a long-term better risk reward?
So full disclosure, we own what I'm about to say. We're finding it very compelling, the commodity space. And to specify, precious metals have done well, particularly gold. And I continue to expect it to do well. But two of the laggard precious metals I'm even more bullish on, and that's silver and platinum. We took a position in platinum late last year. So I think those are two compelling things. I think oil, WTI at $62, $63 is extremely compelling. It is dirt cheap, particularly in inflation adjusted terms. So you have the oil complex, still making money with oil at these prices. We're particularly bullish on natural gas. So if you can buy companies that are still generating cash flow, paying nice dividends at the sort of the bottom of a pricing cycle, which I think it is, because you're seeing U.S. companies that are now laying down rigs, and shale production is likely topping out as getting back to conference calls. Diamondback Energy basically told us that. We're now in a situation where low prices are about to cure low prices, and U.S. shale production is about to offset the increases that we're seeing out of OPEC. Bullish on ag, particularly the fertilizer stocks, also uranium, and finding just a lot of compelling opportunities internationally, both in Europe and also in Asia.
I guess if we could end, Peter, there's been a lot of geopolitical risk. We had what we thought would be maybe a major escalation between India and Pakistan. Russia and Ukraine's unabated. Is there any you think the market hasn't priced in that we should be looking at?
I mean, historically speaking, it's never really made sense to price in anything geopolitical, because nothing really ever was sustainable from it. We saw the Persian Gulf War, but there was really never any disruption in oil barrels. You had Russia invade Ukraine, but there was never any disruption in terms of the delivery of oil barrels, or even, wheat and ag products. Ukraine being the breadbasket of the world, even though there were some production issues, but globally there was not. So typically it doesn't have an impact. I think if there were to be an impact from geopolitics, it would be, China invaded Taiwan and everyone sanctions China, and, the whole world sort of splits into two. That would be disastrous. It would be disastrous for them, and it would certainly be disastrous for us. So that would be the one geopolitical event that would be most concerning. And, but whether that happens or not is a whole different discussion, but that would be the one event that would worry me for sure.
All right. Peter, I could pick your brain all day long. You've been incredibly generous with your time, the hardest working man in macro, in bottoms up work. Thank you so much for joining us today.
Thank you, Tim. Thank you, Drew, for having me. Appreciate it.